WeWork was not a company that failed. It was a fraud that scaled. Not a legal fraud, not a criminal fraud, a structural fraud. The kind where everyone involved pretended to believe something they knew was not true, because admitting the truth meant admitting they had wasted years and billions of dollars on a landlord with a marketing budget. WeWork rented office space, subdivided it, and rented it back out at a loss. That was the entire business. There was no technology. There was no network effect. There was no innovation. It was subleasing with a logo. And for nearly a decade, some of the most sophisticated investors in the world pretended this was worth $47 billion. This was not a mistake. It was a choice. Adam Neumann, WeWork's co-founder and CEO, did not hide what the company was. He simply refused to describe it accurately. He called it a technology company. He called it a community platform. He called it the future of work. Investors did not correct him. They funded him repeatedly at higher and higher valuations. Because stopping meant admitting they had been wrong from the beginning. The delusion was not that WeWork could work. The delusion was that it already did. Neumann raised $5 billion before WeWork ever came close to profitability. The company lost money on every lease it signed. The more it grew, the more it bled. This was not a secret. WeWork's own financial statements showed it. Investors saw the numbers. They invested anyway. Because the narrative was more valuable than the fundamentals. The narrative was simple. Office space was broken. Corporate leases were too long. Startups needed flexibility. WeWork would provide it. This sounded like disruption. It was not. It was arbitrage. WeWork signed 10-year leases with landlords, then rented space to tenants on month-to-month terms. If demand dropped, WeWork was still obligated. The risk was entirely one-sided, and the company called this innovation. Neumann sold investors on the idea that WeWork was building a platform, that its members were a network, that the value was not in the desks, but in the community those desks created. This was marketing. It was not economics. People rented desks from WeWork because the desks were convenient. They did not care about the brand. They did not care about the community. They cared about location and price. And WeWork's prices only worked because it was subsidized by venture capital. The company was not building a business. It was building a dependency on funding. Every new location required capital. Every lease required confidence that future tenants would fill the space. Every quarter required belief that growth would eventually convert to profit. That belief was not based on evidence. It was based on momentum, and momentum is not a business model. WeWork expanded into over 800 locations across the world. It launched side ventures, We Live, We Grow, a private school for children based on Neumann's personal educational philosophy. None of this was profitable. None of this made sense. But it created the appearance of scale, and scale created the appearance of success. Investors did not fund WeWork because they believed in the fundamentals. They funded it because other investors were funding it. SoftBank, led by Masayoshi Son, poured billions into the company, not because WeWork's unit economics worked, but because Son believed Neumann was a visionary. He compared Neumann to Steve Jobs. He said WeWork would be worth hundreds of billions of dollars. This was not analysis. It was belief, and belief, when backed by enough capital, can substitute for reality. For a while, the employees knew. The real estate professionals knew. Anyone who looked at a WeWork lease compared to a WeWork revenue projection knew. The math did not work. But no one in a position to stop it wanted to stop it. Neumann was raising money. The valuation was rising. Employees had equity. Investors had stakes. Admitting the business was broken meant admitting complicity, so no one admitted it. This is how delusion scales, not through ignorance, through alignment. When everyone involved benefits from pretending, the pretending continues, even when the evidence is obvious. Even when the collapse is predictable, because stopping requires someone to say the truth out loud, and the truth was expensive. WeWork's cash burn was over $2 billion a year by 2018. It was not approaching profitability. It was moving further away. The more locations it opened, the more obligations it took on. The more obligations it took on, the more funding it needed. The more funding it needed, the higher the valuation had to be to justify the risk. This was not growth. It was a requirement to keep growing or collapse. Neumann did not see this as a problem. He saw it as validation. He raised a round that valued the company at $47 billion, more than any co-working company in history, more than most real estate companies. No one stopped him. The banks prepared for an IPO, the board approved, the investors stayed in, because everyone had already committed. And once you commit at that scale, stopping is not an option. Moving forward is the only choice, even if moving forward means moving toward collapse. WeWork was not a startup that failed to execute. It was a delusion that was allowed to execute. The failure was not in the collapse. The failure was in the decision to let it scale in the first place. WeWork's expansion was not a sign of success. It was a distribution of liability. Every new lease WeWork signed was a long-term obligation backed by short-term revenue. The company committed to pay landlords for years. Tenants could leave in months. This imbalance was not a flaw in the model. It was the model. And the larger WeWork grew, the larger the imbalance became. By 2019, WeWork had committed to more than $47 billion in future lease payments. It had locked itself into obligations that would take decades to fulfill. The revenue to cover those obligations did not exist. It was projected, and the projections assumed continuous growth, full occupancy, and stable demand. None of these assumptions were guaranteed. All of them were necessary. This is not how real estate works. Real estate is a low-margin business where profit comes from managing risk. You do not sign liabilities you cannot cover. You do not expand faster than demand. You do not treat occupancy as inevitable. WeWork did all of this, not because it had a better model, because it had enough funding to pretend the model worked. Neumann called this aggressive growth. It was not aggression, it was recklessness. The company was opening locations in cities where demand was unproven. It was signing leases in buildings that were not finished. It was projecting revenue based on occupancy rates it had never sustained. And when occupancy fell short, it did not slow down. It raised more money and opened more locations. This created a feedback loop. Growth attracted funding. Funding enabled growth. The cycle looked like momentum. It was actually accumulation, not of value, of obligation. Every new location added fixed costs that would not disappear if revenue dropped. Every lease was a bet that the future would be better than the present, and every bet was made with someone else's capital. The investors funding this were not naive. They saw the cash burn. They saw the lease commitments. They saw that WeWork was losing money at scale, but they had a thesis. The thesis was that WeWork would eventually achieve profitability through density and efficiency, that once it reached critical mass, unit economics would improve. That scale was the solution, not the problem. This thesis was wrong. Density did not reduce costs. It increased complexity. More locations meant more staff. More staff meant more overhead. More overhead meant higher burn. WeWork was not getting more efficient as it grew. It was getting more expensive. The idea that scale would fix the model was not based on evidence. It was based on hope. And hope is not a financial strategy. The warning signs were visible to anyone willing to look. WeWork's occupancy rates were falling. Tenant retention was dropping. The company was offering discounts to fill space. It was delaying rent payments to landlords. It was cutting costs in operations while expanding in real estate. These were not the behaviors of a company approaching profitability. These were the behaviors of a company trying to survive until the next funding round. Neumann ignored the signs. He told investors that WeWork was misunderstood, that the market was valuing it as a real estate company when it was actually a technology platform. He pointed to the app, the community events, the branded merchandise. He argued that WeWork's value was not in the leases, but in the network of members who used the space. This argument had a problem. The members were not locked in. They did not have switching costs. They did not have long-term contracts. They were renting desks. If WeWork raised prices, they would leave. If a competitor offered better terms, they would leave. There was no network effect. There was no moat. There was a logo on a building and a month-to-month lease. By early 2019, WeWork was burning through cash faster than it could raise it. The company needed an exit. It needed to go public. Not because it was ready, because it was running out of options. SoftBank had funded the company to a valuation that private investors would not support. The only way to raise more capital was to access public markets, and public markets require disclosure. WeWork began preparing for an IPO. The banks were optimistic. The valuation target was $65 billion. Neumann believed this was conservative. He told colleagues that WeWork could be worth $1 trillion. Not eventually, soon. He was not joking. He believed it, because he had spent years being told he was right. The IPO process requires transparency. Companies must disclose financials. They must disclose risks. They must disclose governance. WeWork had been operating in private markets where these details could be managed. Going public meant exposure, and exposure meant the model would be tested against reality for the first time. The company filed its S-1, the document that would show the public what investors had been funding for years. The assumption was that the market would see what SoftBank saw, that the narrative would hold, that the valuation would be justified. The assumption was wrong. The S1 did not reveal a misunderstood technology company. It revealed a real estate company with collapsing unit economics, executive conflicts of interest, and governance structures designed to protect the founder from accountability. The market did not see innovation. It saw delusion. And once the delusion was public, it could not be sustained. Scale had not solved WeWork's problems. It had made the problems too large to hide. WeWork filed its S1 prospectus in August 2019. Within hours, the delusion collapsed. The document was not a pitch, it was an admission. Everything investors had been told privately was now public, and what looked defensible in a conference room looked indefensible in print. The financials were catastrophic. WeWork had lost nearly $2 billion in 2018. It was on track to lose even more in 2019. Revenue was growing, but losses were growing faster. The company was not approaching profitability, it was sprinting away from it. Every dollar of revenue cost more than $1 to generate. This was not a path to sustainability. This was a bonfire of capital with no plan to extinguish it. The narrative Neumann had sold for years was that WeWork was a technology company. The S1 destroyed that narrative immediately. The filing classified WeWork as a real estate company because that is what it was. It leased buildings, it subleased desks. There was no proprietary technology, there was no platform, there was a booking app and a brand. Competitors had both. WeWork had nothing that justified a technology valuation, but the financials were not the worst part. The governance disclosures were worse. Neumann controlled the company through a super voting share structure that gave him 20 times the voting power of other shareholders. He could not be removed. He could not be overruled. The board could not stop him. Investors could not stop him. He had designed a system where he had total control and zero accountability. This alone would have been troubling, but the conflicts of interest made it worse. Neumann had sold the WeWork trademark to the company. He owned the trademark personally, then sold it to WeWork for nearly $6 million. He was paid by the company for the right to use the name he had created for the company. This was not illegal, it was obscene. He had also personally invested in buildings that WeWork then leased. He was both landlord and tenant. He was negotiating with himself. The S1 mentioned the conflicts. It did not explain them. It did not justify them. It simply noted that they existed. The public market reacted immediately. Analysts called the filing one of the worst they had ever seen. The conflicts were reported widely. The governance structure was mocked. The financial losses were dissected. Within days, WeWork's IPO valuation was being questioned. Within weeks, it was being slashed. Banks that had projected a $65 billion valuation began lowering estimates. $50 billion, $40 billion, $30 billion, $20 billion. The number kept falling because the justification kept disappearing. There was no comparable company trading at anything close to WeWork's proposed valuation. There was no financial metric that supported it. The valuation had been based on belief, and belief evaporates when the details are public. Neumann tried to control the damage. He announced he would return the trademark payment. He said he would reduce his voting control. None of it mattered. The S1 had revealed the structure. The structure could not be unseen. Investors who had funded WeWork privately were now publicly exposed. Their stakes were tied to a valuation that was collapsing in real time. They could not exit. They could not defend the investment without looking complicit. The IPO was supposed to be WeWork's validation. It became its unraveling. By September, the offering was in crisis. Institutional investors were not interested. The roadshow was a failure. No one wanted to buy shares at any valuation that would allow WeWork to raise the capital it needed. The company required billions to continue operating. The market was offering nothing close. WeWork delayed the IPO. Then it postponed it indefinitely. Then it canceled it. The company that had been valued at $47 billion could not go public at any price. Neumann was forced out within weeks. The board, which had enabled him for years, suddenly decided he was the problem. He was removed as CEO. SoftBank negotiated his exit. He was paid nearly $2 billion to leave the company he had driven into collapse. This was not accountability. This was a buyout. Neumann walked away wealthy. The employees did not. The investors did not. The landlords who had signed leases with WeWork did not. The only person who was protected from the consequences of WeWork's failure was the person most responsible for it. The new leadership tried to salvage what remained. They cut costs. They closed locations. They renegotiated leases. They laid off thousands of employees. None of it was enough. WeWork's obligations were too large. Its revenue model was too broken. The company had been designed to grow, not to survive. And now that growth had stopped, survival was not possible at the scale WeWork had reached. SoftBank took control. It injected billions more to prevent immediate bankruptcy. But the fundamental problem remained. WeWork was a real estate company with long-term liabilities and short-term revenue. That problem could not be solved with leadership changes. It could only be managed or abandoned. The IPO collapse was not a surprise. It was an inevitability. WeWork had been operating in private markets where valuation was based on narrative. Public markets require justification. And WeWork had none. The S1 did not fail because it was poorly written. It failed because it told the truth. And the truth was that WeWork had never been worth what investors claimed. The collapse was not a market failure. It was a reality check. And reality had been delayed for years because too many people had too much to lose by admitting it earlier. WeWork did not die. It was kept alive. Not because it deserved to survive, but because letting it collapse would expose how much capital had been wasted keeping it alive in the first place. SoftBank poured another $10 billion into the company after the IPO failed, not as an investment, as damage control. The alternative was admitting that its previous investments were worthless. This was not rescue capital, it was burial capital. Money spent to slow the collapse, not reverse it. WeWork laid off nearly 3,000 employees. It closed hundreds of locations. It sold off the side businesses that had never made sense. We live, we grow. They were shut down quietly. No one mourned them. The employees who lost their jobs were not executives. They were not decision makers. They were people who had been hired during the expansion, told they were part of something revolutionary, and then discarded when the revolution turned out to be a subleasing company that could not pay its bills. Their equity was worthless. Their severance was minimal. They carried the consequences. The landlords who had signed long-term leases with WeWork were stuck. They had given the company favorable terms because WeWork promised scale and stability. What they got was a tenant that could not pay. Some landlords renegotiated, others waited. All of them lost. The investors who had funded WeWork spent years pretending the investment made sense. SoftBank wrote down billions, but the write-downs were treated as market corrections, not mistakes. No one called it what it was: a failure of discipline, a failure to say no when the numbers did not work, a failure to stop a founder who should never have been allowed to operate without oversight. Neumann walked away with nearly $2 billion. He did not apologize. He did not admit fault. He gave interviews about lessons learned and next ventures. He said WeWork had been misunderstood, that the timing was wrong, that the vision was right but the execution was flawed. This was revision. The vision was not right. The execution was not flawed. The entire premise was broken. WeWork eventually went public in 2021 through a SPAC merger. The valuation was $9 billion. Not $65 billion, not $47 billion, $9 billion. For a company that had been called the future of work. That had been compared to Amazon and Apple. The SPAC merger was not vindication. It was liquidation with paperwork, a way for investors to exit at a fraction of what they had put in. WeWork's stock price fell immediately. It kept falling. By 2023, the company filed for bankruptcy. The outcome that had been inevitable in 2019 finally happened. Just slower and more expensive. This was not a story about innovation failing. Innovation never existed. This was a story about discipline never being applied. WeWork was allowed to scale because stopping it required admitting that the initial investment was wrong, and no one with enough power to stop it wanted to admit that. The venture capital model is built on the idea that most bets fail, but a few succeed at scale, large enough to cover the losses. WeWork was treated as one of the potential successes. It was not. It was a predictable failure that was funded anyway, because the people making decisions were not spending their own money. The banks that prepared the IPO collected fees. The lawyers who structured the deals collected fees. The consultants who advised on expansion collected fees. Everyone extracted value except the people who believed the company was real. The employees, the small investors, the landlords who took WeWork's promises seriously. This is what happens when a delusion is allowed to scale. It does not collapse cleanly. It collapses slowly, spreading damage across everyone who touched it. The people responsible walk away. The people who believed pay the cost. WeWork was not a cautionary tale about moving too fast. It was a cautionary tale about moving at all when the foundation is missing. The company never had unit economics that worked. It never had a competitive advantage. It never had a reason to exist at the scale it reached. But it was funded to that scale anyway, because growth was confused with progress, because valuation was confused with value, because narrative was confused with reality. The lesson is not that startups should move slower. The lesson is that investors should say no, that boards should govern, that founders should be stopped when the business does not work. WeWork was stoppable at every stage. In 2015, in 2017, in 2019. The information was available, the math was clear, the model was broken. No one stopped it because stopping it was expensive. Continuing was expensive too. But continuing meant the expense was distributed over time. Stopping meant admitting failure immediately, and the people in position to stop it had already committed too much to admit failure. WeWork was not a failure of vision, it was a failure of accountability. A system designed to let founders operate without constraint. A funding model designed to reward growth over sustainability. A governance structure designed to protect executives from consequences. The collapse was not inevitable because markets are unpredictable. It was inevitable because the business never worked, and everyone involved chose to ignore that until ignoring it was no longer possible. WeWork did not disrupt real estate. It demonstrated that real estate fundamentals apply even when you call yourself a technology company. It proved that subleasing at a loss is not a business model, no matter how many times you call it community. The company raised over $20 billion. It destroyed most of it, not through bad luck, through bad design. And the design was not accidental. It was chosen by Neumann, by the board, by the investors, by everyone who had the ability to stop it and chose not to. That choice had consequences. Thousands of people lost their jobs. Billions of dollars disappeared. And the person most responsible was paid to leave. That is not failure. That is what success looks like when accountability does not exist.